US would be part of the strategy. I actually like some of the opportunities in the second and third tier China cities in residential, where I think the leverage actually is probably less than 25%, so I'm less concerned about increasing interest rates. I actually think that if you look at markets such as some of the Scandinavian markets, there's some opportunities over there. Some of the larger banks are getting out of Scandinavia, so there may be assets to acquire there. As a U.S. investor, I'd still be probably overweight the U.S. I would probably not go into some of the smaller emerging markets simply because there's no need to be in every single market, and I think that over-diversification probably results in a detriment to performance.
Okay, George.
First market I'd invest in would be India, if the money are available today. We noticed in India after the recession a lot of, with foreign capital being able to come in 2005, everybody rushed and a lot got tripped up, and so we really see a little bit of a shortage of capital there, and we see some very nice opportunities. So I would say that would be number one. I would consider China number two, and perhaps a little bit in distressed U.S.
Okay. Thanks, Kevin.
I would love to find some distressed opportunities in the U.S., but they have not been forthcoming. And maybe I think that will start to loosen up as more, gets disgorged from the CMBS market, and the special servicers kind of catch up to the trouble that's sort of still on the horizon for the CMBS market. But outside of the U.S., we think that actually that the high yield debt space in Europe is very interesting. It's not a sophisticated market like it is in the United States. But we've seen a lot of opportunities over there that on a risk-adjusted basis look pretty good to us. And then I would, again, outside of the U.S., the longer term is a lot clearer than the shorter term. If you look at the, this consumer class, this middle class migration, economic migration that's going on in Latin America and Asia, I think there are a lot of exciting opportunities. We're focused on Brazil right now in retail and industrial, and also in Asia in retail generally, in a bunch of different places in Asia. So,
now in the U.S., what asset class would you go for?
I think there is still an opportunity in apartments, mainly through development. There's a lot of talk, as everybody knows, but there still are not yet a lot of starts. So if you're able to get in the ground quickly on apartment development in the United States, you should do pretty well, but be prepared to get out in 2 or 3 years.
Pre-sell that. Mark?
And I'm going to first answer it. I'm assuming the money we have is U.S. dollar denominated.
But are you going to ask me if it's levered?
No,
oh,
no.
Okay.
Only the reason we say that some
Nobody's asked me that.
Well, is it levered?
Yes.
All right. But the reason why I say that is that some countries I'd like to invest in, but the cost of hedging has become very expensive, especially if it's a 3 to 5 year horizon and you're trying to hedge your profit. I mean, I think first I don't think you can avoid Asia. I just think the growth and the urbanization and the creating a middle class is going to go on for decades, and I think it's powerful. Although I think there is a very attractive structured finance product over there, because as I said earlier, leverage there is 50%. So you're so much lower in the capital stack. You're doing mezz, what U.S. would consider, not even the bottom half of a senior loan. So I probably would look at doing that. In the U.S., the first thing I would say is, and I would do more opportunistic, it's probably because I run our opportunity funds at AW, but I would limit it to, I do a couple of things, limit it to real rent growth cities. I think as George and Kevin said, real estate's an inflation hedge, but if you look at so many markets, both in the U.S. and around the world, there's very few markets that can ever prove that they have either not only real rental rate growth, but nominal rental rate growth. And it's great you can put rental rate growth in a computer, but there are, just go to 495 in Boston. Rents today are lower than they were in 1985. So it really would be limited to those markets for the majority, say the half that went to the U.S. And, we're finding a lot of, I'll call it more than other people, distressed loans because we're approaching it differently. And then the other thing I would do is I probably would take 20%, and even though it's against my grain, go to what I would call, the next tier cities, because I think there's so much pressure on the banks right now. Because I'll give you a real example. 3 years ago, to get a bank to lend to you, you would have had to give them your cash management, give them your FX, and a lot of other things. One of our banks yesterday, who we're doing a loan with, basically said, if you put $5 million of your cash, we'll give you 20 basis points. If you put over that, we're going to reduce your basis points to 5 because we have a 75% loan to deposit ratio, and I only get paid 20 basis points from my treasurer. So I think you will see some of the assets for a short term, because I think, when you go to secondary markets, it's a momentum play, reprice because of the pressure that's going on all throughout the world on low yields, and do that, but do it in markets where the assets can reprice quickly so that you can get a multiple.
Mark, that's a commendable smorgasbord. So it's about $2 million per investment. I got it. You're hedged out. Okay. So, Rob?
Yeah, I'm going to give a very specific response to my circumstances, but then try to generalize it. The place where I'm seeing the best opportunity now is for us to, in a sense, reinvest in our own portfolio. Until the Federal Reserve was paid off a few months ago, and they were a secured creditor of AIG, we were under very kind of strict marching orders to, accelerate, maximize cash, cut down on commitments. It was kind of a gun to your head liquidation strategy, and don't come back to us looking for money for anything. So we did as we were told. With the Fed having been paid off, and with the guidance of the folks who I work with at AIG Corporate, we're given more room now to kind of reinvest the liquidity that we have and really manage the portfolio a little bit more dynamically. And with that, we've got the ability to effectively reinvest in our portfolio. To give an example, we have a newly constructed apartment project that's leasing up with a crappy partner and a debt that's coming due, and a whole host of issues that normally at that point we would have just boom, hired a broker and sold it. Now we can really sort of do the analytics and say, well, gee, we can buy out our partner for not much. We can resize the loan and really look at a 3, 4, 5-year hold. And in many of these cases, we're looking at, 13, 14, 15%, IRRs on projects that we know really well, and we feel like that's a good risk-adjusted return. And I mentioned, we have this venture in Eastern Europe. We're about to start a development project, prime site in Warsaw, which is a very strong market. And to get the development kicked off, we were going to go for very expensive mezzanine capital, 24% minimum, 2 times multiple minimum, a percentage of the profits, in a project where we had, multinational tenants knocking on our door, to pre-lease the first building. But up until the point where the Fed was out of the picture, we just didn't have the latitude. So we then had the latitude to reinvest in that. We've got this project in Korea where we've got a portion of the project that we committed to close a fund to get the project done, which is probably a 30 or 40% IRR piece of paper, where we had a lot of pressure to sell that. Now we can hold on to it. And so I look across that, and it's very particular there's no theme here, okay? This is very particular to being inside the AIG portfolio, but with the first $100 million, we can create great risk-adjusted returns. So what does that mean more generally? In the prior panel, one of the panelists made the comment about partnering up with banks, good bank, bad bank, or somehow teaming up with somebody who's a portfolio holder in some distress. And so I think the interesting theme would be to sort of look across the landscape, whether it's here, in Europe, in Asia, and look at who are the large holders who are still in distress, and is there a way to become a proven capital partner, or a good bank, bad bank kind of capital partner, to take advantage of the optionality that resides in these portfolios, because there's optionality in all of them. And if you can get access to that optionality, and really zero in on the winners and invest selectively, you know, I think there's some interesting opportunities in kind of all of the above, everything that everybody touched on here.
See, real estate really can be fun. I'd echo a lot of that. I go 40-40-20. I'd go 40% into Brazilian development companies who have chronically undercapitalized and have great market growth. I'd go 40% into India Mez structured finance company and fund. I'd go 20% into U.S. multifamily development. But listen, you've I think all demonstrated that you know, the old phrase, the meek shall inherit the earth, and may be true in some quarters, but in real estate, it's, I think, the savvy consolidators and opportunistic investors who will inherit control of large portfolios. And well, thank you very much. You've all been a great panel and a great audience, and have a great career.
Nice meeting you.
Rob, you're having too much.